I want to just tap in here and let you know how the market's been and what it means for your portfolio. If you've been following the headlines, you know that 2026 has been, well, anything but quiet. The conflict with Iran and the disruption of with the Strait of Hormuz have been dominating the news cycle. Understandably so, of course. Yet, despite the geopolitical turbulence, the S&P 500 continues to grind just a little bit higher. Now, I understand it may sound reassuring on the surface, but as we look beneath the index, the picture is a little bit more complicated and more important to understand. A more narrowly driven market, of the 11 sectors that make up the S&P 500, only 2 have really been doing the heavy lifting so far: energy and technology for this year. Now, energy has been a standout performer, and broad participation across all oil producers, refineries, pipelines, and energy service companies, all benefiting from this supply disruption that's happening over in the Strait of Hormuz, which historically carries about 20% of the world's supply of oil. Now, on the technology side, growth within that sector has been remarkably concentrated, driven entirely by the AI trade, specifically with semiconductors and data center infrastructure. The companies building and powering artificial intelligence have been an enormous investor interest, while the rest of the technology sector has been relatively quiet. The result, well, that is an index that looks really healthy from a distance, but reveals significant weakness when examined more closely. Think of it like a sports team where 2 players are carrying the entire offense while the rest of the roster sits on the bench. That kind of coordination is not a sign of a broad, healthy market, and it tends to come with the price that we've all seen: volatility. Now, in today's environment, news travels fast. Social media posts travel even faster. A single headline can move markets within minutes. And when the gains are concentrated in just a handful of names, well, the swings can be dramatic, as we've seen. Now, when we take a look at the Iran conflict and the oil outlook, since February, the U.S. and Israel military operations against Iran have triggered significant disruption to the global markets. Iranian forces declared the Strait of Hormuz effectively closed as of early March, and while ceasefire discussions have picked up more momentum, oil prices pulling back meaningfully from their 2026 peaks as diplomacy advances, the underlying supply picture really remains complex. Even if we reach a deal soon, which that's what's expected, we do not really expect the oil prices to simply just snap back to pre-conflict levels overnight. The reason is straightforward. Infrastructure takes time to rebuild, and tankers take time to transit. It's about 60 days on the tanker side of the transportation. A vessel making a trip from the Persian Gulf to the U.S. shores represents a journey measured in months, not weeks. Much of the energy infrastructure in the region will require significant rehabilitation before production and shipping, so that shipping can go to its pre-conflict levels. Now, what we really need to do is really think about and acknowledge a wild card. If and when a resolution in Ukraine allows sanctions in Russia to be lifted, Moscow is going to face an enormous pressure to maximize oil exports to help stabilize its economy. That additional supply, while potentially dampening prices longer term, is unlikely to arrive quickly to offset the disruption that we're facing here in the near term. Our view is that energy and energy-related positions remain very attractive to overweight for right now. We are watching the ceasefire discussions closely and will adjust accordingly as the situation begins to develop. Now, there's one cautionary flag, and that is beyond the energy and technology. We are beginning to see encouraging signs of a broadening market. Sectors that were largely absent from the 2026 rally, with Healthcare, consumer staples, and real estate are starting to show renewed momentum. Now, what history tells us when market leadership expands beyond one or two sectors, it is generally a healthier and more durable environment for investors. And we welcome this development. However, there's one area that we are watching, consumer discretionary. Now, this sector, which tracks spending on non-essential goods and services, is continuing to show weaknesses. Consumer confidence has been under pressure from higher energy prices, persistent inflation, and that economic uncertainty. This matters because consumer spending is what drives 2/3 of the US economic output. When the consumer pulls back, it's a signal worth heeding, one that we are monitoring closely in our portfolios. Now, as we begin to look ahead with the midterm elections here in November, history serves as a useful guide. Markets have typically increased volatility in the months leading up to the midterms, followed by stronger performance over the uncertainty of the election that is behind us, or once it's behind us. So we believe that this pattern is worth keeping in mind as we navigate the second half of the year and remain cautiously optimistic about those opportunities that lie ahead.